Good morning, good afternoon, good evening, depending on where you are. I am Danny Roderick. I'm currently the president of the International Economic Association. Very happy to be chairing this session that the IEA has co-organized with the Finance and Development Lab in Paris. Particular word of thanks to Isaac Diwan, one of our speakers, who's really done the bulk of the work in putting this session together. Our subject is debt, and this is really a quiet crisis that's been brewing in the developing world for some time now. I think even though some of the major debt restructurings and debt defaults have hit the headlines, whether it's Zambia or Sri Lanka, I don't think there is sufficient awareness of how dire the situation in terms of liquidity and accessing private credit markets and bond markets the low and lower middle income countries are facing. We're in a situation where essentially net financial flows to these countries in Africa, in particular, has slowed down to a trickle. Many of these countries have lost access to bond markets, and all of this liquidity squeeze and being pushed into dire debt distress is taking place at a point where the challenge of development, whether it's the immediate challenge of dealing with the lingering effects of COVID, or dealing with the effects of rising food and energy prices, or the medium-term challenges of the climate transition, the green transition, and navigating development strategy towards a kind of a new growth models, where all these challenges have accumulated in front of low and many middle-income countries, and this dearth of liquidity and the accumulating debt distress is proving to be a fundamental challenge that's blocking progress. So this is the second of our panels on this issue. The first conversation had focused on Zambia and Sri Lanka in particular. You can see a recording of that on our website, International Economic Association. And in this panel, we're extremely lucky to have a very distinguished set of speakers. We have 4 speakers. I'm going to be introducing each of them when their turn comes up. And also 2 very distinguished panelists. We are planning for roughly an hour and 15 minutes, which means that each one of our speakers has to be very, very disciplined. I'm going to give each of them 10 minutes to make their opening remarks, with the idea that we might have a little bit of time left for interchange in the last 15 minutes or so. Those participants who are listening to us and have questions, I'd encourage you to put them in chat, and I may bring those up in the discussion section. So our first speaker is going to be Vera Songwe, who's currently the chair of the board of the Liquidity and Sustainability Facility. Before that, she was Undersecretary General at the United Nations and the Executive Secretary of the United Nations Economic Commission for Africa. And before that, she had a long career at the World Bank. And Vera is going to set the stage for us and talk about some of the key issues in that context. Vera, the screen is yours.
Thank you. Thank you very much. I'm going to just very quickly try to share my screen, which we tested before and we said it worked. So I'm going to do it again. There we are. So let me start by particularly thanking Ishak and the team, Danny and yourself, for bringing us together to have this conversation today. I think it really is an important conversation we're having. 1, because we need to sort of set this conversation in context, but 2, to begin to ask what is it that we need to do to see how we at least move countries away from the current difficult crisis that they're having. You did say in the beginning, Danny, and I'm very happy that we're now beginning to talk about debt and liquidity, because I really believe that we need to look at these two issues as sort of, you know, competing issues, and one that is sequenced in a sequential way. First liquidity, and then of course debt. But most of it is coming, we must agree, I think, unlike in 2008 and even before, where we had a long conversation about decoupling, or a lot of a conversation around the emerging markets not being totally interconnected with the developed world. Today, what we know is all the way from Burkina Faso to, of course, South Africa, from Malaysia to Brazil, we are totally intertwined with what happens in US markets and in European markets. So any kind of sneezing in this market does create a lot of stress and tensions on the emerging markets. So the first slide and I want to sort of establish some of this. The first slide that I want to show is just what has been happening in the last 24 months, basically with currencies across the emerging markets. Because of a tightening of policies in the United States, we're seeing huge depreciations of a lot of currencies. We've seen some readjustments after, as we can see, but, you know, first there was that hit. So, you know, with no sort of policy decisions from the emerging markets, you see a hit on the currencies. The second thing, of course, that we all talk about when we talk about debt is debt in itself is not bad, right? And I think we need to continue stressing this, is the cost of debt, the kind of debt, and the use of proceeds of the debt. And in the graph that you have in front of you, if you go from the most dark green line, in some sense, which is sort of close to the 200 basis points, that's what the emerging markets and the developed world has access to when they go to the markets to raise resources. And so essentially we talk a lot, every time we talk about concessional resources, we talk about sort of, it looks like, you know, the developed world is giving the emerging markets, or middle income and low income countries, you know, cheap resources. But really, when you think about it, the developed world borrows every day at concessional resources, right? They borrow at less than either rates. That's what makes it. And even as they borrow at less than either rates, let's remember that debt to GDP levels in the United States, in Italy, in France are all either nearing the 100% or above. So, you know, we're talking about 60% debt to GDP levels in many of the emerging markets. But the red line is the frontier economies, the Senegals, the Cote d'Ivoires. So even at best, when they're doing the best macroeconomic policies, when there is a shock like COVID, you know, their spreads immediately at 1,000 basis points. If you're borrowing at those kinds of rates, it's no surprise that we're all sitting here today talking about debt, right? Because the cost of money is so high that, you know, even before you start putting that money to use, you know, you're already suffering from payment. And this is just a sense of, you know, what is happening with defaults. Look at post-2020 to 2023, the yellow line, the red line, and the black line. The black line is countries in the emerging and frontier markets that have already defaulted. The red space is what I showed you, sort of emerging markets that have access to very expensive debt, are on their way to default, is the red bar. And the yellow bar is still spreads at 700 to 1,000 basis points. So all of that segment are the countries that are trying to get to markets and getting to markets, but are essentially rates where in 2 years, we'll all be sitting here having a conversation again about, you know, what are we doing with debt to GDP? Why are countries defaulting? How can we restructure it? And really the conversation here is how can we make sure that those countries have access to resources that are cheaper, so that essentially they can do and respond to this crisis in the same way that the developing economies have responded, but without the stress of worrying about falling into a debt crisis. This is, and most of this data is coming from the IMF, the Financial Stability Board, and the World Economic Outlook of 2023 that was just recently released. Why am I talking about liquidity? If you look at the bar graph on your right-hand side, you will see debt payments and debt service coming to maturity. And if you look at January 2024, that long bar, $16 billion is going to be coming to maturity in January 2024. And these are payments that emerging markets, frontier markets need to honor to their creditors. If they cannot do that, they go into default. in this group of countries, you have countries that are growing at 6%, countries that are growing at 4-5%. So their long-term growth is positive, but all of a sudden they will wake up one morning and they'll have this huge bill that they have to honor. And if they cannot honor that bill, they will get into trouble. And the question is, can we, and we've seen this in the United States and in Europe, where for corporates that had huge sort of, immediate payments or liquidity needs, there was a facility that was put in place to help them sort of roll over and get over that, as opposed to wait for them to declare default and wait 3, 4, 5 years to sort of unravel themselves with the G20 framework that it's not working. Can we begin to think about an international financial architecture structure that allows for some kind of liquidity of the last resort funding that makes this work? And I think this is the important point. I think the systems today, the financial infrastructure and architecture that we are working and operating in, does not allow us to have those kinds of liquidity backstops of the last resort. And so we always talk about death, and let's go back to HIPIC, because we're talking about what we know. But we have advanced so much that we must also begin to advance some of the tools that we have in hand to be able to work. And I'm going very quickly now. These are some of the sort of liquidity that is flowing into countries. You will see, and I want to focus a little bit on the last panel, the yellow lines. It's the SDRs. Countries are using SDRs as a liquidity backstop. And so essentially what we have seen is that there have been liquidity backstops for the emerging, for the developed economies, of course, the United States, Europe. We keep talking about this $23 trillion that was put into the developed world during COVID and during the war in Ukraine. Why can't we find a global asset that we can also put to use for emerging markets? And we must distinguish between countries that have a deep-rooted macroeconomic fundamental problem and countries that have that one-off payment that needs some liquidity to help them roll over. There are two different sets of countries with two different sets of problems. So I'm not saying here that let's go in and help every country that is about to get into default, but we must begin to distinguish which ones we can actually then help stave off and let them continue to go back on their growth path. I'm stopping and I'm finishing here with a focus on growth. We need to go back to a focus on growth. One of the things that's happening is that we don't yet have a comprehensive growth framework for the emerging markets. And so what is happening, and this is sort of the IMF projections for the next year, essentially what we are seeing is that growth risks are at the highest they've ever been. The lower they are, the higher the risks are. And so essentially, while we're struggling to figure out how we fix debt, if growth risks are this bad, it means that we're going to have debt problems for a much longer time. And so we need to also begin to work on how do we bring growth back? What are those actions? What are those policies that we need to put in place globally to get back to a steady state growth rate? Because that is the only sustainable long-term way. Actually, the best tool to fight debt is growth. And I don't think we are having a conversation enough about what it is that will bring back growth. Of course, then we go into industrial policies and how we're managing them, and export bans and supply chain restrictions that are happening in the world. And that is probably a much deeper conversation that will affect our debt and our liquidity and market access than the conversation that says, how do we solve the debt problem, which today anyway we cannot solve. Thank you very much. I stop there.
Thank you, Vera. Thank you. I think that was extremely useful. The focus on liquidity, the focus on the possible use of SDRs as a vehicle for liquidity, and the very important point about not losing sight of growth as ultimately the only way we can sustainably solve these debt problems. Our second speaker is Ugo Panizza. Ugo is a professor of international economics, and he holds the Pictet Chair in Finance and Development at the Geneva Graduate Institute of International and Development Studies. Aside from his academic studies and research, he has also considerable professional experience working with the World Bank, the Inter-American Development Bank, and UNCTAD. So Ugo, the screen is yours.
Thank you very much, Danny. Thank you very much, also Isaac, for inviting me to do this. So Vera highlighted the risk that we could have a wave of default. And I've been asked to talk. I'm going to share my screen while I'm talking. If I can do it, share. Does it work? I hope you're seeing it.
It does.
Okay, thank you. So Vera highlighted this risk of default, and so I've been asked to talk about one of the tools that can be used by countries when they're restructuring the debt post default, and this tool are value recovery instruments, and these value recovery instruments are particularly important because they're being adopted by a few countries right now, and there is proposal to use them in more countries. So I think it's good to talk about this. Let me start by my conclusion. So in a nutshell, I think that VRI, value recovery instrument, are a good idea in theory, which so far has not worked well in practice. And I have doubt that it will work well in practice in the future, but let's see why. So to make this point, I will use a very simple numerical example, and then spend a couple of minutes discussing two specific cases, that of Suriname and Zambia. So this is my plan for the talk. So let me start with this super simple example. So I'm a big fan of Lee Buchheit, and he always talks about this mythical country of Ruritania. So let's assume that Ruritania has a capacity to pay that can be described by this table. There is a 25% probability in which the country can pay 110 plus something, this small epsilon, a 50% probability that it can pay 100, and 25% probability that it can pay a little bit less than 90. So these are my assumptions about the capacity to pay of the country in, say, 1 year. And I'm going to make 3 more assumptions. One, that is the country doesn't want to default, because very bad things are going to happen to the country if it defaults. So I'm not discuss this, but let's assume that the country wants to repay. And this is very much in line with the current empirical evidence. So there is this famous IMF paper that says that countries default too late and too little. So the country always tries to repay, and this is a deviation from the, let's say, benchmark model that economists use, which is the model rooted in the Eaton and Gerswick strategy. And I'm going to assume that in case of default, capacity to pay goes down by 20%. So this is a completely arbitrary number, but so that's my assumption. So these are my assumptions. So let's see how this country can borrow. It can borrow in 2 ways. One, it can just issue a plain vanilla. So this is my vanilla con bond, in which the country, let's say, issue a 0 coupon bond, which will have a size, which will require a payment of 100 in 1 year. What is the expected value for the creditors of this bond? Well, it's 93. Why it's 93? Because the country will pay 100 with a 75% probability, and with a 25% probability, it will pay 80% of 90, because I assume that 20% capacity to pay is destroyed if we are in this bad state of the world. Alternatively, the country could issue a contingent bond, that is a bond that pays depending on how well the economy is doing. So it could issue a contingent bond that pays 100%, 110 if the economy is doing well, 100 if the economy is normal, 90 in the bad state. In this case, the country will never default because the country is always able to pay. And the expected value for the creditor of this bond is 100. So it's clear from this super simple example, and one can make it more complicated, that the contingent bond, like the cone with many flavors, it's preferable for the investor with respect to the plain vanilla bond. Now, investor clearly prefer the contingent bond, and if the country doesn't like to default, it will also prefer the contingent bond because there is 0 probability of default. One could even imagine different structure in which the expected payment is somewhere between 93 and 100, and this would make everybody happier, and this all depends on the bargaining power of the country and of the investor. Now, this is state contingent bond, and this is why economists tend to like state contingent bonds. They don't work very well in practice, but in theory, they are nice. Let's think about a value recovery instrument. And I started with the contingent bonds because the value recovery instrument is similar to a contingent bond with two differences. So first of all, what is a value recovery instrument? So a country cannot service its debt. It has to restructure its debt. So it's going to lower the present value of its claims. But to give a sweetener to creditor, we're going to add something to the new bonds issued that says that if things go well, creditors get a little bit of this improvement of the economic condition. So there are many examples here. So for instance, you can think of debt restructuring, in which the restructured bonds have payments which increase if the price of the commodity exported by a country increases, or if new commodities, oil or other commodities, are discovered. One can think also of instruments in which the payment is linked to GDP growth. There are two differences with respect to a standard contingent bond. First is the time at which this VRI is issued. That is usually done as a part of a restructuring and not in normal time, like one contingent bond that can be issued at any time. And this is important because it might affect bargaining power of the two parties. The second difference on which I want to focus is that while the contingent bond in my example tends to be symmetric, that is, if things go well, the bond is going to pay more, and if things go badly, the bond is going to pay less. The typical VRI is not symmetric, but is asymmetric. There is a baseline payment which increases if things go well, but does not decrease if things go poorly. And if you remember my previous example, all the value of the contingent debt was linked to the fact that it allowed to avoid default, and thus would allow this reduction in capacity to pay that happens at the time of default. So just one could, I don't want to go into the details because it would take me too much time. They're listed here. But when I try to build, if one tries to build a value recovery instrument using the assumption that I used before with this specific symmetry, we get that it's going to be a very different ranking of preferences of the country with respect to the preferences of the investors. And in general, for the country, a value recovery bond, it's a good idea only if the baseline, that is the payment, if nothing happens, is the realization of capacity to pay in the worst possible case. And there is a worked out example here. I'm not going to go over here. So a value recovery instrument works well for the country only if the baseline capacity to pay is set at a very low level, which is not the standard thing that we do in debt restructuring, in which the baseline is set at the expected capacity to pay. And that's a key problem with the application of value recovery instruments. I'm not going to spend time talking about the case of the GDP warrant in Argentina. Martin Guzman was here, wrote a very nice paper, which shows that it turned out to be incredibly expensive. This is a quote from a veteran sovereign debt lawyer that basically says the same thing. At the end, countries get very little debt relief, and if things for adding a value recovery instrument to a debt restructuring, and if things go well, the investors are going to gain a lot and countries are going to pay a lot, but they don't get much debt relief. Let me just finish quickly, because I don't want to run out of time, by quickly mentioning two examples. And here I have to thank Theo Maret, who is a true sovereign debt nerd, and he has this Substack on which I get all my information. So let me just conclude with the example of Suriname and Zambia. These are relevant because there are two recent restructuring which included a value recovery instrument. So Suriname had a debt of 775 millions, which was transformed into 650 million of new bonds, plus 10 million of expense bonds. So basically, the face value haircut was nothing. So we went from 675 to 660, 2%. The real haircut, when we include past due interest, is 25%. But on top of this, the restructuring agreement included a value recovery instrument, which would start paying if there is oil, if there's significant oil production in Suriname. This is Suriname. This is very high, 315 million with high interest rates. And it might lead to a situation in which the new debt for Suriname, the restructured debt, will be more costly than the old debt. It is like a negative haircut. And it's not clear why this should be given to creditors, given that creditors have issued this original bond with very high interest rate when Suriname had no oil, and the high interest rate was supposed to compensate for the fact that lending to Suriname was very expensive. So this seems not right. Similar thing.
Well, maybe we can just. I thought the Suriname example made the point quite well.
Okay.
Time. Maybe we can just leave it here, and maybe we can come back to.
I stop here. Okay.
Thank you, Ugo. I appreciate it. Our third speaker is Chandrasekhar, and my apologies to all the speakers for rushing you because we have a lot of interesting presentations and limited time. Chandru is currently a senior research fellow at the Political Economy Research Institute at the University of Massachusetts in Amherst. He's also the global director of research for International Development Economics Associates, commonly known as IDEAS. And before that, he had a long career as a professor at the Jawaharlal Nehru University in New Delhi. Chandru, go ahead.
Thanks, Danny, and thanks to Ishak also for inviting me to join this. Well, what I'm going to speak about is not really an innovation, because that has a sort of positive tone to it, but really to look at what has become now a tendency in most restructuring exercises, which is to try and insert into these restructuring exercises, not really the restructuring of external debt, but the restructuring of domestic debt as well. And the argument here is essentially that what you want to try and create is fiscal space in these countries to be able to get them to meet their commitments in a new trajectory in which you're trying to put debt onto a sustainable level. So that's really the argument which underlies this focus. And the first country in which this was sort of implemented, even before they actually got the IMF loan, was Ghana. And subsequently, this is being implemented as well in Sri Lanka. Now, there are three issues which come up here. The first issue, of course, is really is it correct to blur this distinction between external debt and domestic debt? Because what we're trying to deal with is really a problem which arises in the context of the inability to be able to service or to meet commitments on external debt. That's the debt crisis we are speaking of. But in the process of trying to resolve that, we blur the distinction between domestic and foreign debt. Now, this is important because of the fact that the issue with foreign debt, as has been mentioned, is really that the lack of access to adequate foreign exchange to be able to meet payment commitments on debt, as opposed to domestic debt, where, of course, the state has much more control, or the state and central bank has much more control. You not only have control because of the fact that domestic debt has to be paid in domestic currency most of the time, or nearly almost all of the time, but you also have the fact that that you're not merely in a position to be able to get the central bank to do the needful in order to release the liquidity, but you also have a state which has the right to tax, and therefore the ability to be able to mobilize the resources to meet commitments on foreign debt without any difficulty, so long as it's willing to tax, so long as this is income and wealth inequality, and thus be able to clear this debt quite easily if the willingness is there. On the other hand, if you're speaking of foreign debt, of course, as we all know, the problem is we need to transform domestic currency and domestic resources into foreign exchange. And really, the problem really lies in the inability to be able to transform. And when you're not able to transform, to access the liquidity, as was mentioned by the first speaker, at times which are very crucial. So there is a fundamental distinction, and blurring this distinction essentially does away with the kind of issues which need to be confronted in the context of an external debt crisis. Now, the point is not merely that you have this blurring of the distinction, which has implications, but you also have evidence that there is a problem associated with it, which is the second issue which I'd like to flag, which is the inability of countries which actually agree. Zambia didn't, but Ghana and Sri Lanka did, which actually agreed to accept domestic debt restructuring, to be able to do so in a fair manner. So if we, for example, take Ghana, in Ghana's case, of course, in all of these cases, we know the domestic debt in substantial measure is held, besides the central bank, is basically held by the commercial banking system, by pension and insurance funds, and by sundry domestic financial institutions like mutual funds, etc. But dominantly, it's held by the commercial banks and by pension and insurance companies. So if that be the case, then what you're basically saying is that these are the entities which need to be approached to take a significant haircut as part of a perspective in which the issue is not external debt per se, not really the problem of transformation of domestic resources into foreign resources, but the issue is merely one of creating fiscal space with a focus on gross financing needs, which is your overall borrowing requirement in whichever currency it might be in a year, plus the amount which you need to repay in that particular year. That is really the gross financing needs that you need, which you need to look at as the argument of the IMF and those who support domestic debt restructuring. Now, if you look at the fact that these set of entities are the principal entities which hold debt, then it depends on which country you're in. In Sri Lanka's case, for example, the central bank decided that the banking system was in a situation in which if it poses a burden in terms of restructuring the debt, which are owed to the banks, then the banks would become insolvent. If they become insolvent, it will be self-defeating because given the kind of consequences of insolvency or let's say systemic insolvency in the banking system, you'd have the state to come in to recapitalize these banks, and which is self-defeating because the idea is to be able to mobilize resources when you're actually getting into a situation where you're going to be spending resources in order to recapitalize the banks. So you actually had we have in Sri Lanka much of the burden of the domestic restructuring falling on the pension funds, but of course not all of it. A certain amount of it, of course, is taken by the central bank to the extent that, particularly in the case of treasury bills, the central bank holds these bills in significant measure. But on the other hand, look at Ghana. In Ghana's case, we have exactly the opposite because Ghana actually entered into this process 2 years or a little more after a major recapitalization of banks as a result of a banking crisis. So at the moment, it appears that banks seem to be in a position where they can be solvent if they actually forced to take a haircut on domestic debt. But the pension funds, which the holders of these funds basically decided to come onto the streets. There was major protests. In fact, the pension funds refused to accept an offer made by the state in which there would be a significant reduction in an exchange of pre-existing bonds for new bonds, a sharp fall also in the rate of interest which is being offered. They refused to accept this, and therefore we had between February and July, February was the first offer, in July you actually had a new offer in which the pension funds were given a major sweetener in which they actually get in return for agreeing that there would be a lower coupon in the first 2 years, such that you could show on your books that you're not actually making these expenditures. You get over time actually a rate of return which is significantly higher than the rate of return you got on your earlier bonds. So you can see the differential impact that in Ghana, it depends upon the political economic situation. In Ghana, you can't get the pension funds to do that, and therefore you drop that. On the other hand, you put it on banks because of the fact that you have banks which are relatively more solvent. But this too can be self-defeating because if the banks now take a significant haircut, which they are, you could end up with a situation where you have another banking crisis and therefore another need for recapitalization. Now, finally, and I'll just conclude with this, there is the question that if this is the approach of domestic debt restructuring, what is the perspective which underlies this? And obviously, the perspective which underlies this is that if you're able to squeeze domestic investment in consumption, and this is my speculation, of course, if you're able to squeeze domestic investment in consumption to release resources, of course, in the first instance, we are speaking about financial resources, this simultaneously releases a set of resources, real resources, which can be put into commodities, which can actually be transformed such that you can ensure that the foreign investor or the foreign creditor actually gets repaid as a result of this restructuring process, that actually taking a significant cut in terms of domestic debt and creating fiscal space also automatically resolves the transformation problem. Now, we actually know that in countries which have tried to do this, what you actually have is a significant decline. You don't get the profile of incomes that you expect to get on any sort of debt sustainability trajectory. And if you don't get that, you have a whole host of other problems. You actually have exports also not doing very well in many of these contexts, and therefore you don't see this transformation. And actually, therefore, it is essentially a process of imposing a kind of a recession, creating maybe not, because it depends upon what happens to the tax revenues of the government, more fiscal space. Likelihood is that tax revenues would fall when growth falls, and therefore you don't create the fiscal space. And you'd end up not even realizing that kind of a dream where just the release of fiscal real resources would, over a period of time, because of a cut in investment consumption, automatically transform them into foreign exchange, which can allow the foreign debtor to meet it. Well, there's only one last line, which is, if you actually look at the Sri Lankan case, what this has amounted to is that in the sharing of the haircut between domestic debt restructuring and the restructuring of foreign debt, you're going to end up with a situation, if you follow the debt sustainability analysis, where the foreign creditors not only take a much smaller haircut, but you end up with a situation in which something like 4 or 5 years down the line, the country is seen as being in a position to be able to repay by borrowing more money abroad. So you're basically putting it on a trajectory where it can actually access more. It's presumed to be able to access more foreign exchange, I think, in 2027. So you really are attempting to do this. You're attempting to do this by imposing a recession, but you're doing it in a way in which, by blurring the distinction between foreign debt and domestic debt, you're making an assumption about transformation, which is unlikely to be realized, so that you'd have a recession, regressive welfare effects, as well as a tendency to not actually ensure sustainability of debt in the immediate future. I think I'll stop there. Thank you.
Thank you, Chandru, for bringing out those 3 critical sets of issues when we include domestic debt restructuring as part of the overall external debt restructuring. So the last speaker on the panel before we turn to the discussants is Ishak Diwan. Ishak, as I said at the outset, is really the main organizer of this session. He is the research director of the Finance and Development Lab in Paris. And he's working with organizations across the Global South on issues related to sovereign debt, multilateral development bank reforms, and green finance. He's a professor at the École Normale Supérieure in Paris, and before then had a long career at the World Bank. So, Ishak, please go ahead.
Thank you, Danny. Well, great to follow on Vera, Hugo, and Chandru. I mean, you brought to the table some of the main issues that came when discussing debt restructuring in the recent cases, and the cases to be, the issue of liquidity, the use of VRI, the new issue of domestic debt. Another controversial issue that came up recently a lot is how to treat multilateral development debt, and in particular IDA's debt, in these restructuring. And there's been arguments made that they should I'll share my screen, that they should share in, do you see my screen? Yeah. They should share in the debt restructuring, share the burden. Now, and this came mostly from the Chinese side, that argued that these losses need to be shared more broadly. and that their own loans are also developmental, and so why not share the burden also with IDAs, especially when we talk about the lower middle income countries. So we've done some work at the Finance for Development Lab on this issue, and actually we tend to think that it's a good idea for IDA in particular and other MDBs to share in the losses. There are good arguments why they should not. They provide positive net transfers. They now, even IDA borrows from the market, they need to preserve the AAA rating. They are lenders of last resorts. So there are many arguments why they should not, but actually there's a good argument why they should, which is that they're really hurting from the debt crisis. And by sharing in the losses, they could, in a more energetic way, if you like, push for restructuring when this is needed. And they really hurt in two ways. IDA hurts in two ways. One is that for highly indebted countries, it provides grants instead of loans. And so it doesn't have these reflows of debt service over time that it could redeploy elsewhere. And second, and probably even more hurtful, IDA's aid effectiveness really comes down in countries with high level of debt. IDA calls countries with high level of debt red countries, and now about half the countries it supports are red countries. In those countries, you can calculate that on average, for every dollar of net transfer that IDA puts in, 60 or 70 cents go out as debt service to other creditors. So the leakage becomes very large. That's the net transfer, the negative or zero, very small net transfers that Danny and Vera were talking about. And so to bring those countries from high debt to medium or low debt is really in the advantage of IDA in the long term. And to do that, sharing in the losses would make it a much more effective actor in pushing for debt restructuring, whether it's liquidity, rescalings, or debt reduction, depending on whether it's a case of illiquidity or insolvency. Now, the important point we make is that in the cases of the poor countries, there is a very heterogeneous set of creditor, going from market all the way to very concessional loans. And therefore, the usual rule for the comparable treatment don't apply. And we need new rules that are fairer, that take advantage of these very different grant elements. And IDA has the most grant elements. And that if you develop these rules, then the actual cost for IDA is pretty modest. So in the rest here, I'll just show you a few numbers to support my claims. Here, you see a table that shows you all the debts to the IDA type countries, about 400 billion right now. And you see the set of creditors is very diverse. IDA has around 20%, but then you have private creditors at 30%, China, other bilaterals, multilaterals. And in this slide on the right, you see the grant element in these loans. Very diverse. Private market have zero grant elements. The Chinese on average, here we look at public and private Chinese loans, 20% grant element, going all the way to 45% for IDA loans. And when you add IDA grants, all the way to 58%. So it's a huge variation in grant elements. Now, IDA has suggested that we should consider, so if you have $1 of debt with 50% grant element, it's really, you can think of it as a 50 cents loan, market loan, and a 50 cents grant being packaged into a loan with 50% grant element. So IDA has suggested that we should call the grant element of a loan an ex-ante debt reduction. Think of it as debt reduction given ex-ante. So when the time for debt reduction comes, we should consider that part of it has already been given. So the fair COT rule that we propose takes this into consideration. So, for example, if a country needs a certain amount of debt reduced, total debt from all its diverse creditors, we'll start with the creditor with the lowest grant element, and we'll reduce its debt until it reaches a debt reduction equal to the grant element of the next creditor, and then the next comes in. So that, you know, as you go down until the whole amount of debt that needs to be reduced is reduced, exposed, all the debtors for which debt has been reduced are now at the same exposed grant elements. So that would be a fair COT rule. I'll spare you a beautiful graphical illustration we have of this.
Maybe one more minute, Isaac, because
exactly, one more minute. Last slide. So we did some projections using all the countries for which debt reduction looks as needed in order to reach debt ratios that the IMF considers as low risk. And here are what 3 rules give you in terms of IDA losses. The unfair proportional rule, the fair rule, and an extra fair rule where you also take account of the grants that IDA gave. And so you see the losses for these 23 countries go down from 7 to 1 to less than $1 billion for IDA with the extra fair rule. And this could be provided, by the way, in terms of new loans, which are also concessional. So the average of this would be 20% more new concessional loans during the 3-year adjustment period, which incidentally is more generous than what happened in the Zambia case itself. So already IDA is actually sharing in the losses. In the case of Zambia, it provided grants for 3 years after debt reduction when Zambia was not risky anymore. So just to conclude, you see the red countries of IDA going up over time and the green countries with low risk coming down. We claim that for IDA to be able to push the red down to and the green up, it should take debt reduction, and but it should do it in a fair way, and the rule we proposed would lead to low losses. Back to you, Danny.
Thank you very much. Thank you, Isaac. And we have 2 discussants who have taken on the very difficult task of responding and amplifying this already very, very rich set of presentations. So let me quickly turn first to Hanan Mursi. Hanan is the Deputy Executive Secretary and Chief Economist at the United Nations Economic Commission for Africa. Prior to that position, she was the Director of Macroeconomic Policy and Research at the African Development Bank, and she's also worked at the EBRD and the IMF. So with that, Hanan, please go ahead.
Thank you very much, Danny, and many thanks to all presenters for the excellent presentations and very thought-provoking analysis. I'd like to perhaps kind of start with what we have not said in some of the discussions. So let me start with the analysis that has provided. I think, the whole idea of what we're discussing now in terms of issues of rising vulnerabilities and increasing pressures and the nexus between, the debt service, the need for climate action, the need to invest in SDG, has really been a product of declining concessional finance for the, more than 15 years. And this is where, that led to changing of the landscape, particularly for African countries, for basically a move to more private and commercial and new creditors. So that's kind of, the background. And this, as issues have been rising with the increasing debt vulnerabilities and the number of global shocks. We had the introduction of the G20 common framework to try to resolve the issues. However, it has not, unfortunately, worked as hoped in terms of like timely delivery. It has not been time bound. It has not been effective. And some of course, the issues that have been, behind the scene, basically. So, for example, reforming of the G20 Common Framework is one of the things that everybody agrees that there is a need to do, but nothing gets actually moved. And the reason it doesn't get moved is actually that evolution of the landscape and geopolitics. So, for example, Ishaq, discussed a very pertinent issue of whether or not, the multilateral development banks should take a haircut. So, if you're asking me the question, upfront, should it do? I would say no. Not on their balance sheets would be my answer exactly, because that will have serious implication going forward for the availability of concessional and affordable finance for developing countries going forward. When it was done, and the modality it was done, for example, in HIBIT, it was done, but not on the balance sheet of MDBs. It was done actually through a subsidy account through which donor countries put funding, through which that was facilitated. Currently, what is complicating that landscape is that emergence of new creditors. So basically, if we would have that subsidy account, who's going to be subsidizing and what is their interpretation of that subsidizing? So are they, those donors, Paris Club, that are putting money, are they, have the perception that they are subsidizing new creditors and Chinese creditors? And if China to put the funding in there for that subsidy account, there is also the issue of how they feel about the representation in the IFI system and that they don't have sufficient voice there. So there is a huge geopolitical issue at hand in this. What I like and what Ishaq has been trying to take us through is that formula, is that it provides an alternative to somewhere where there is like, we're stuck. Just having a subsidy account to do it for the, to have some sort of a haircut for MDBs that is paid by that subsidy account is not going to materialize. We have to have innovative solutions on what are the alternatives. And I think thinking of elements, grant elements that MDBs can provide that, function in a quasi way similar to having a subsidy account makes a lot of sense, and is something that the new creditors are open to as well. So it can move the agenda. So I think it's a very, useful concept to pursue, because it deals with realities on the ground in terms of, geopolitics, in terms of things, issues where we are really stuck. But I would really caution for on issues of for MDBs to take that on their balance sheet, particularly for regional development banks, because that affects their credit ratings, their abilities to raise these funds and channel them going forward. So I think we need to keep it within that framework of just having these grants, but not on the balance sheet of the MDBs. I would just perhaps on that paper, and I really appreciate it's a brilliant document. I would like to just raise a few things there. One is the issue of what is the likelihood of the non-concessional creditors to be willing to take that deal, and what does it imply for credit rating going forward? What is your sense of what are the kind of the implication of going with such a proposal for credit rating, and also the uptake of non-concessional lenders? Another issue that I would like to maybe put on the table is we are focusing so much on the haircuts and how to do calculate the formula of comparability of treatment, but there has also been some proposals, for example by President Ruto, of other ways of handling that, whether through profiling of payments, grace period for repayments, other modalities through which we can consider resolving the issue, not necessarily through a haircut. So I feel this area there hasn't been sufficient discussion, and I'd be very interested in the thoughts of all the speakers on that area. And how plausible is it relative to all what we have discussed? There have been, so many interesting things. I know I have limited time, so I'll try to be as brief as I can. But for example, on the issues of domestic debt, I think one of the issues that I felt we have not touched upon in the discussion is the implication of actually having a domestic debt restructuring on the trust and credibility of the banking sector. So, what is the cost and benefit of actually doing that in terms of financial stability and trust in the banking sector? But also, I think I like the point that was mentioned about, it depends basically on initial conditions. So it depends on who holds that domestic debt. Is it the banking sector? Is it the pension funds? Who are the holders? And then what is the initial conditions of these holders? So I think it was very interesting in the case of Ghana, the issue that they had been already recapitalized earlier, so it was possible. But I think at the heart of all this discussion is also a political issue of who do we want to bear the consequences of the haircut. Do we want the pensioner to be the ones? Do we want the households, the corp? So I think at the end, this is a critical part. And I think, in many countries where it's not easy to get to a stage where you have trust in the banking system, I think we need to be very careful in actually taking the route of going through domestic debt restructuring unless it's unavoidable. And then also there were also a number of comments by Vera on issues of the need for liquidity. And I completely agree that this is at the heart of the issue, that we need to really look at the need to going forward to ensure the availability of finance at scale. Affordability is the core issue. And that's why part of doing that, in my view, would be through multilateral development banks. And this is why it's really important to ensure that we're not, shooting ourselves in the foot by, ill-positioning them for the future to take on more of that. And also, I think the SDR can play a much bigger role, whether through SDR rechanneling to multilateral development banks so that it can have more leverage. Or actually, even going forward, I think we need to have some reforms in the SDR, the IMF special drawing rights, to actually reform the formula upon which these SDRs are allocated. Because currently, SDRs are intended to provide long-term liquidity needs of the global system. Yet, when we allocate them, it's allocated according to economic size and the reserves that that country holds. So basically, if you're bigger and you're in a better financial position, you get more. It doesn't take into account your liquidity needs. So I think we need to reform that for SDR to meet the spirit of what it was established for. And this should be part of the discussion going forward. And we have to tackle that issue of availability of finance, actually be able to, meet what Vera had mentioned on the refocus on growth. There is a need to do that, but through availing sufficient financing. I think I've run out of my time. Looking at Danny, over to you.
Thank you. Thank you very much, Hanan, for keeping to your time. Last but certainly not least, our final discussant is Martin Guzman. Martin is currently the co-president of the Initiative for Policy Dialogue at at Columbia University. Martin, of course, served as Minister of the Economy for Argentina between 2019 and 2022, during which period he led the management of a sovereign debt crisis that included the second largest sovereign debt restructuring to date. So Martin, please take over.
Thank you, Danny, and thank you to the International Economic Association for organizing a panel on an issue that is so important, and to the panelists for the very insightful presentations. So we know that when sovereign debts are unsustainable, they need to be restructured. Otherwise, the countries fall into destabilizing dynamics that affect the welfare of the people. And in every restructuring, there are two levels of conflict. The first one is between the debtor and the creditors. It's key to define what's sustainable. And the second is among creditors, the inter-creditor problem. So the papers and the presentations in this session address both issues. And also, one of the presentations focus on how can we make debt contracts more sustainable as to avoid some restructurings, because restructuring debt is costly, the processes are protracted, there is nothing equivalent to a bankruptcy code for sovereigns, which means that when there is a problem of debt distress, there has to be decentralized negotiations between the debtor and a myriad of multiple creditors. So the first presentation by Vera provided a very clear overview of what's happening right now. And I think the main takeaway is that there are going to be more troubles. Not only we have troubles now, but in a context in which we have higher global interest rates and quantitative tightening. When debts come due, and we are seeing a pickup again in 2024, more countries are going to suffer debt distress. So it's going to be key to look at what the other papers and presentations looked at. So then Hugo focused on the issue of contingent debt and DRIs. And he claimed something that some of us who have been both doing economic theory, but also in policy making, have faced directly. So these instruments in theory are good. Why are they good? Because contingent debt aligns payment capacity with scheduled payments. So they are supposed to improve sustainability. But in practice, they don't seem to be working. And I think the key puzzle here is what happens with valuation, how creditors value these assets. I actually faced this issue in policy making in Argentina in 2020, when I led the sovereign debt restructuring of the country. And for a long time, I've been writing and thinking about these instruments in a positive way. But faced with the reality of a restructuring, I decided not to include any contingent debt instrument because markets gave no value to it. So ultimately, this would have led to a significant effort in the upside scenarios for the debtor, with no gain if markets just give no value to those instruments. But ultimately, I think we need to understand more why creditors value these assets in the way they do. Then Chandru focused on the issue of restructuring or the treatment of domestic currency debts in sovereign debt restructurings, and the fact that these instruments are different than foreign currency debt instruments, and therefore the frameworks for the treatment of the different instruments should be different. I think the problem, the particular problem with Sri Lanka that Chandru mentioned, is the way the IMF implements its debt sustainability analysis in the context of the use of the framework for market access countries. So the problem is that all the debts are mixed. So the IMF defines thresholds for what's sustainable: the debt to GDP ratio, the debt service in foreign currency to exports, and the gross financing needs to GDP. And if these thresholds are not met, then that is not sustainable. But by pooling the domestic currency debt and foreign currency debt, this creates incentives for putting some burden on domestic currency debt, so that creates more space for paying foreign currency debt. But that's flawed, and this is an important issue in the current process of restructuring because of the medium and long-term consequences that not treating different assets appropriately, and in this case differently, would have for the development of domestic capital markets, and therefore for the capacity of countries to borrow in domestic currency and avoid currency mismatches in the future, which is key for economic development. Then, so finally, we had Ishak's presentation. Ishak's presentation focuses on the issue of comparability of treatment. And in particular, the focus is on the IDA eligible countries that don't have much debt with the private sector. They have a significant burden of the debt with the multilateral development banks. And when it comes to the first problem, to define sustainability, Ishak defines it in terms of two thresholds. The present value of the public or publicly guaranteed debt to GDP cannot be higher than 40%, and the present value of public or public guaranteed debt to exports cannot be greater than 180%. So if these thresholds are not met, then according to this criteria, there has to be a restructuring. And what the paper does is to come up with a new rule for a comparability of treatment that intends to the rule tries to provide a more fairness for the definition of what comparable treatment would mean, and it defines a grant element. What's the grant element? It's the difference between the face value of the debt and the present discounted value of future debt service, principal and coupons. Or in the case of MDBs, it will be the interest payments. And in order to compute the present discounted value, it uses a discount factor of 5%. So then if for comparability of treatment, the grant element is computed as relief. That means that those that provide concessional lending will face a lower haircut than those that don't provide concessional lending, because the grant would be counted as relief already. So I have a few questions for Ishak, if there is time for discussion. The first one is whether you compute the negative grant element as well. You know, private creditors provide financing at coupons that are much higher than 5%. That's what also Vera was showing. And the same is true for China, for even for Paris Club in many of those cases. So when we do comparability of treatment, are we also computing negative grant element for non-MDBs creditors? The second question is about when we define sustainability, ultimately, what we need is the transversality conditions must be met. And we compute a measure called debt stabilizing primary fiscal surplus. This value, which we call small s, is equal to debt to GDP times the difference between the interest rate, the average interest rate at which we expect the country to be able to refinance the debts, minus the growth rate of output. And in discrete time, we divide by 1 plus g. So in a case in which the interest is lower than the growth rate of output, what would be the problem? Why are we saying that there needs to be debt relief for debtors that get the chance of rolling over debts at concessional rates, even lower than the growth rate of output? So my question is, how do you deal with this? Why do you use always these thresholds rather than referring to the debt stabilizing primary fiscal surplus? And I have no more time, so just one last comment, which is related to Hannon's comment to Ishak. So it's about the endogenous consequences of applying a rule for comparability of treatment on the future lending costs. do you take into account how the application of this rule would affect the future cost of borrowing for debtors that today are in distress? I'll stop here. Thank you, Danny.
Thank you very much, Martin, and thanks for rushing through those. I've already asked Isaac to offer us some brief final reflections at the very end of the session. So I'm going to hold off on Isaac for the last moment to handle those questions. But I wanted to turn to Vera, Ugo, and Chandru for any brief reactions. I emphasize brief because we're running out of time. I want to add in case you feel so inclined, a question that came from the audience from Peter Doyle, who made the following reflection, which is that a lot of what we're talking about today is about how to make restructuring better for borrowers. He expresses concern that creditors, including the IMF, actually want to make restructuring painful for borrowers in order to be able to drive stronger ex-ante policies, adjustment policies on the part of the borrowers. And so he asks, what, if anything, can be done to persuade creditors, both official and private, to emphasize such less painful remedies in order to improve the restructuring. So lots of issues on the table. So I'm going to just ask if you have anything. So let me do it in reverse order. Let's start with Chandru, if you want to add a few things.
Yeah, just two quick responses. First to Hanan. Yeah, I agree with you that, finally the issue is what would this do to the trust of the banking, trust in the banking system. But I think, if at all one can find a logic in this, this is trying to move the system into a situation in which bail-ins become normal in bank restructuring as opposed to bailouts, where depositors who actually have nothing to do with the fact that you have an external debt crisis on your hands are required to take a haircut in order to be able to create the fiscal space, which in all probability is not going to help you resolve the external debt crisis. And this is essentially the political economy issue. You're basically, whether you deal with pension funds or banks, in the case of banks, of course, you're also going to affect the amount of credit which comes into the system if you create bank insolvency. But more importantly, you're pushing the burden onto people who obviously are least responsible and are least in a position to be able to take it. And a quick response to Martin, yeah, I agree with you that this has implications for the domestic capital market. But essentially what we have perhaps is the following, that once we take into account international inequality in the way it has evolved, it's going to be a very long time before countries cannot but depend on a certain amount of imports, both for investment purposes, but in many countries to meet even basic essential needs like food and of course fuel and energy. So there is going to be balance of payment stress in a context in which you're not able to match that with exports. So what you're doing now is, rather than address that basic problem of overcoming what is an external financing difficulty, you're basically creating a situation where you create a domestic financing difficulty by destroying capital markets, by doing the same thing, that basically saying that, listen, am I going to actually treat sovereign debt as riskless and allow pension funds and insurance companies to put money into it? Or am I not going to allow that? In which case, what is the state going to do? Yeah, thanks.
Thank you, Chandra. Ugo?
So very quickly to Peter Doyle, I think we should be fair to the fund, and I think their position has changed quite a bit. I think that I would say that the majority of people at the fund no longer adhere to this view that, you should make debt restructuring as costly as possible. I think there is still a big share of the financial industry that think that way, but I think the thinking at the fund has changed, which I think is a good thing. And just one brief reaction to what Martin said. He said it much better than me. There's this massive disconnect between theory and practice. And so it was interesting that Martin was written paper and knows all the benefits of contingent debt. When he had to do it, he didn't do it. And this idea that markets give absolutely no value to something that should have value, it's a major puzzle, right? It makes us doubt that markets are on the efficiency of markets. So let me close it here.
Thank you. Very, very puzzling indeed. Yes, Vera.
No, two things. The first is on the liquidity issue. And we have seen with the crisis, the emergence of this debt service suspension initiative, which is a timid sort of liquidity provision experiment. The question now is, we have tested it. We know it has worked. It worked temporarily. Can we now move it onto sort of a standard policy of the IMF and actually write it in and do it in a more sustainable way? 2 years doesn't work. Maybe we need to do it in a much more sustained manner. And again, distinguishing between countries that are getting one-off shock and need additional liquidity from sort of fundamental bad macroeconomics. The second is, as I showed during the presentation, when you have the private sector asking for 1,000 basis points of spread, and they're already building in default, so that at a time when default occurs, you can say, Martin, and this is maybe the other side, Ishak, of your proposal, now looking at creditors, is that if you have been taking, 1,000 basis point spreads, when there is a crisis, and I see Martin shaking his head, then we're assuming that you have already sort of ex ante internalized the probability that there was going to be a crash. And so the haircut conversation should be a much more different conversation. And I don't think we're taking that into account enough. And maybe using then the sort of differential between investment grade spread and frontier grade spread, that 800 basis points should be part of what we're looking for when we start looking at debt restructuring. And I don't think this point has been sort of analyzed enough, and we should do some more work on that.
Thank you, Vera. So the important point is that at those rates, the creditors have been compensated ex ante in any case. So the last word is Ishak's.
Thank you. This has been a very rich conversation. Maybe to conclude, Danny, we can elevate it a little bit. I mean, what is the character of this historical moment? I think we could ask, especially for the low and middle income countries, the lower middle income countries on which we're focusing here. It seems to me the most important thing is the climate risk, the realization in the past few years that the climate risk is immense, and the work of people like Vera that show us that the adaptation effort for these poor countries in order to be able to neutralize the effect is large, 2 to 4% of GDP in extra investment per year for the next 20 or 30 years. So that's really the situation on growth. Now, with the recent shocks, we find ourselves in a situation of illiquidity. How do we interpret that? It has to do with the fact that there are many heterogeneous creditors that don't know how to work together, and some kind of inability to coordinate. To coordinate what? The fact that you need to maximize the size of the pie in these countries to benefit everyone, the country and the creditors. But instead of that, we're seeing a rush to the exit, basically, and a situation of illiquidity. It should be interpreted as a coordination failure. Of course, some countries are insolvent, but many countries are illiquid in a very specific sense. Now, the good thing that has happened is that MDBs have been empowered to take the lead in resolving this issue, in scaling up what they can provide to help on this investment issue. However, from a burden sharing perspective, this cannot be done if the rest of the creditors remain uncoordinated and just try to milk as much as they can from this financing. And so we have to think of the MDBs playing a lead role in organizing the rest. And this is very much the kind of DSSI++ that initiative that Vera talked about, or the kind of initiative that President Ruto is talking about in Kenya. And it involves, in many cases, rescheduling, somewhat forced rescheduling, but in a way that would benefit actually all the other creditors. And in a few cases, the hard cases of debt reduction, as we've seen in the common framework. I think this is the contour of what's emerging. So, maybe not enough time to respond to precise questions, but this, I think, discussion gives us kind of this broad framework that correspond to the historical realities of the moment.
Thank you very much, Isaac, for that summing up and for organizing this session. Thank you very much for our speakers, Vera, Ugo, Chandru, Isaac, and of course our discussants, Hanan and Martin. It has been a rich discussion. I think, and as Isaac said, I think some of the contours of a way out seems to be feasible, but I think what seems to me to be critical is for advanced country capitals in Washington and in Europe, sort of a greater understanding of this linkage between what's required for the broader climate transition and the growth transition in the developing world, and that what that means for climate and sustainability, and how this debt effort has to be, and the liquidity effort is fundamentally linked to that. And of course, what makes that difficult, particularly in places like Washington, is when these connections are very difficult to make in the context of a very polarized polity. Trying to make them in the context for the world as a whole on behalf of the low and middle income countries seems to be even more difficult. But we need to retain our optimism and work towards sort of intellectually coherent solutions. And I think this conversation has been an important step in that direction. So once again, thank you, everyone. Thank you to the audience. Apologies for those questions that we could not address, but it has been a very stimulating discussion. Thank you all. Bye-bye.